Hi, everyone. Welcome to the new episode of Blocks and Business, the podcast about blockchain and how blockchain is playing a massive role in this institutional and the enterprise space. And today we have a very exciting guest, Mike Manning, who is the head of institutional finance at Ava Labs. And we have a very exciting topic for today's theme, which is trade finance reimagined from paper to programmable assets on blockchain. So first of all, I would like to welcome Mike. Hi, Mike. Welcome on the show. We would love to know about your Web3 journey so far and your role at Ava Labs.
Well, thank you very much for having me. I'm glad to be here, and I love talking about this topic, which is close to my heart in what I do. I lead institutional finance at Ava Labs, which means I spend most of my time working with banks, asset managers, and financial institutions that are exploring how to put real assets on blockchain rails. The conversations, I would say, have changed dramatically in the last 2 years. We spend a lot of time explaining why blockchain was relevant to finance. Now institutions are coming to us with specific use cases and asking how to build, which is a lot more fun. Avalanche's architecture was designed for this. We're designed with these particular requirements in mind from the start, which is compliance, privacy, speed, the ability to customize. That makes us a natural fit for serious institutional deployment, which is why I think we're seeing such high levels of adoption right now.
Got it. No, I think that's definitely very, very true. So, Mike, we started our journey at Zeeve with enterprise. We worked with quite a few banks and enterprises way back before COVID. But then at that point of time, we saw the adoption was very, very slow. So before even jumping onto why asset-backed finance is gaining a lot of traction, just generally on the institutional adoption side, what kind of, from your perspective, why this macro shift we are seeing in the last 2-3 years?
Yeah, and we've worked with you obviously quite a bit, and I think part of it is you and the infrastructure and the maturity of the market, as we'll get to perhaps a little bit later on. But I think the core reason that Avalanche is seeing the level of adoption is that we were really built for institutional requirements. We weren't retrofitted for them. Avalanche is not a single monolithic chain, but an ecosystem of independent but natively interoperable EVM L1s. That ecosystem is anchored in C-chain, which you can think of as a faster, cheaper Ethereum. This is where Franklin Templeton, BlackRock, Apollo, Van Eck, Janus Henderson, and Galaxy have all deployed funds. It's where Circle and Tether and about a dozen other stablecoins live. So it is a public, permissionless chain that has the broadest possible reach. And as such, it's a very vibrant economy and ecosystem in and of itself. However, it also serves as the liquidity hub for the broader ecosystem of Avalanche L1s, which are arrayed alongside it. So the L1 architecture that we were built around from the beginning lets institutions run their own dedicated chain with their own validators, their own compliance rules, their own tokenomics, their own privacy controls. These are not rollups, they're not side chains, they are independent sovereign chains with no dependency back to the C chain for settlement finality, which is important. However, even though they are sovereign and independent, they are natively interoperable with C chain and with any other Avalanche L1. And in practical terms, that means that you can send money or messages or assets across any chain within the Avalanche ecosystem with no third-party bridge. That makes transfers fast, single block settlement time, inexpensive, and safe because you've got no third-party risk vector. But stepping back a level from a business perspective, this opens a much wider design space for companies. It means that institutions don't face the same kind of difficult trade-off between public or private that you typically do in this space. They can execute across both at the same time. Financial transactions and applications are complex multi-party or multi-workflow products. And an institution, for example, could put sensitive positions or transaction flows on an L1 that they kept private. The L1s can be public or private, but then still settle out in USDC on C-chain, where you've got the biggest pool of liquidity. So Avalanche gives institutions the control they need without sacrificing the connectivity that they require to do business in what is effectively a networked market. And the proof comes in who's building here. All those companies I mentioned a moment ago, Franklin Templeton, BlackRock, Apollo, Galaxy Digital, These are not pilots, but they were live deployments in production with real capital at stake.
Got it. No, I think that's a very interesting point you have mentioned. And we believe that based on the use cases, some use cases, work very well when the use case is deployed on a public chain like Avalanche C chain. And some use cases may require a lot of some kind of permissioning in addition to the public flavor to it. So more of a public permission kind of chain, or it can be fully permission chain, which you rightly said, Avalanche L1 is one of the exciting stack to do that. And you can have your own compliances, you can have your own privacy and so on and so forth.
And the thing I find, you begin to break this up, and so because they're so natively interoperable, you can create a different product architecture where you are in both simultaneously, and you've got data segregation and privacy segregation across multiple execution zones, and you can really do more things with a chain that is natively interoperable rather than, and we do bridge out to third-party chains. It's not an island, so you can bridge out to any other L1, but it's just not as quite as clean and as instant, and it's harder to deliver the cross-chain atomicity that is important for a lot of these applications.
No, absolutely. I think even if a lot of permission use cases, especially when we talk about tokenization use cases, you do require access to liquidity, you do require interoperability with other ecosystems. End of the day, there's always a retail side to it, right? So liquidity, interop, etc., becomes super, super important. Now coming to the topic of trade finance, the whole asset-backed finance or trade finance has been a long-standing use case. There were quite a few initiatives earlier like TradeLens or Marco Polo. But unfortunately, they didn't scale as expected. Either they were too ahead of time, or I believe the necessary ecosystem was not there. So in your view, what are the challenges which the traditional trade finance ecosystem today face? And what are some of the reasons why some of these earlier blockchain initiatives to solve these challenges could not happen, could not, scale as expected?
Well, let's start with asset-backed finance in general, because it's a broader category than trade finance. And then we can dive into the specifics around trade finance. The reason I'm so excited about asset-backed finance is that it is perfectly well suited for blockchain. In a lot of ways, that has been what we have been doing already. DeFi, asset-backed finance shares the key characteristic of DeFi lending, which is that the backing collateral is a definable asset that can be seized in order to make good on the loan in the case of default. So all over collateralized crypto lending is a form of asset-backed finance, although we don't call it that. Drilling down a level, though, I think that there are even greater efficiencies to be gained when we start to move traditional asset-backed finance on chain. And that's because that is where we start getting into the kinds of operational efficiencies that blockchain is great at delivering. We start to improve the performance of the asset class, not just the leverage that we can apply against it. So a typical asset-backed financing facility or value chain is complicated. It's got multiple layers of assets. It's got a lot of paper. It's got a lot of intermediaries. It's got a lot of reconciliation. This is true certainly in the trade finance area, but it's also true in all asset-backed finance. So to follow a typical flow through for people who are not intimately familiar with it, it typically starts with an originator who underwrites a loan, given loan, like a mortgage or a receivable. That becomes the building block of the whole system. They then post that into a warehouse facility in order to borrow money against it to go make more loans. The warehouse is the second layer of asset, and that's got its own rules. It does eligibility tests. Is this collateral coming in that's being posted valid? Concentration limits, haircuts. There's a whole asset in and of itself in the warehouse. And then at some point, either the originator or another structure will come along and sweep those loans out of the warehouse and put them into a third asset, which is the structuring pool. And a senior as junior note will come off of the back end. It's now a bond or a security. And through this whole process flow, you've got interest repayments coming in on one end from the borrowers, flowing into the warehouse facility, and then flowing out through a waterfall mechanism to the first, second, third loss position bondholders on the far side. So historically, securitization has effectively been composable finance without composable infrastructure. it actually didn't emerge until we had a technology advance, which was the development of the personal computer, which allowed Lou Ranieri and spreadsheets to operate this composable workflow in something approaching a reasonably efficient way. It couldn't have been done before personal computers. Well, now we don't have to do composable finance without composable infrastructure. We have a technology that is purpose-built in a way for exactly this kind of a flow. So this is where blockchain really comes into its own. It provides a single source of truth, which eliminates reconciliation and, crucially, as we've seen recently, fraud, assets being double pledged. It converts paper-based contracts into digital objects, which makes them composable through all these steps of the workflow and modeling that I just mentioned. And it automates these complicated workflows in a smart contract in a way that is observable and is reliable for everyone. So it's really about, as I said earlier, it allows us to improve the efficiency and the safety of lending, not of leveraging against a loan that has already been made. So that's why I'm very excited about the asset class in general. And we can talk a little bit more about trade finance in particular, but I thought it's because a lot of those things will then begin to apply.
No, absolutely. I think those are some very interesting points you mentioned, especially the securitization. I think we have already seen it's such an inefficient in the traditional finance. And I think blockchain can play a massive role to not just bring in trust, make it very, very agile. People can participate. And I think we can see a larger securitization market without hampering the underlying assets. So coming to the trade finance piece, trade finance, I think, is massive. Domestic or international trade finance, both are a massive industry. And there have been a lot of challenges. We had a chance to work with a few of them. And we realized whether it be documentation, whether it be legalities, whether it be, all kind of processes that need to be done. The number of intermediaries are huge, importers, exporters, freight forwarders, and importing bank, exporting bank, and so on and so forth. So based on your experience, what are some of the key areas that blockchain would be able to solve, as compared to what other technologies have been able to solve in the trade finance space?
Yeah, well, I think sort of part of that question is the one you first asked, which is, given that everything you described, large numbers of intermediaries, complexity, those are all things that blockchain could theoretically solve. So why hasn't it been solved? Why have we had so many runs at this? Because there have been several, as you alluded to. And what's happened? Well, I think a lot of them ran into the complexity problem. So because it's so paper-based, because you've got bills of ladings and letter of credit and invoices, documents that move by courier, documents that need to be tracked across multiple ports, you've got, number one, an enormous reconciliation burden, but you've also got an enormous complexity problem. And so digitizing a whole complex process like that end to end is extremely difficult. You have this massive 0 to 1 problem. And so I think a lot of these early initiatives like TradeLens or Marco Polo didn't scale as they had hoped because they really ran into the network effect problem. So trade finance is only valuable if all your parties are on it, and getting all of these competing brokers and logistics providers to adapt a shared platform was extremely difficult, especially where one party controls the infrastructure. So there's also a governance issue. Is everybody going to feel comfortable coming onto Maersk's platform when in many cases they're competing with Maersk? So that was another big part of the problem. Stepping back, I think that though there was also a challenge, and this will get into where what I think how people should approach the market today, which is that they bit off more than they could chew and more than they needed to chew. So all of these very complex workflows are in a lot of ways like a Web 2 problem. They're about getting people on the same APIs and getting them to execute. And a lot of the work is on the software design and the application layer. And that's not something that blockchain magically solves. Blockchain is very good once you've got the data on chain, manipulating it and moving it. But that movement, that interface with the chain is really important. And that's where you're going to have to go upstream and touch all of these different systems. And so I think that inevitably caused them to divert a lot of work and effort and resource into these off-chain kinds of activities. And you've seen some of them. Some that started out in blockchain have basically defaulted back to a more of a Web 2 solution. So that diverted them away from the parts of the blockchain that I think are particularly valuable for trade finance, which is once you've got an asset defined, it can be exchanged, it can be pledged, it can be settled very, very rapidly, and that's where a lot of the efficiencies come from. So I think it was they started too broad. I think we'll eventually get there, but starting in a very, very wide, very, very complex scenario makes it harder to solve that cold start problem, that 0 to 1 problem.
Right. No, you're absolutely right. I think we have seen this, even in traditional Web2 system, if you see any ERP, it does not cover the entire supply chain for an organization because, there would be intermediaries, like it may be wholesalers, it may be retailers, it may be customers who are outside the system. So, of course, adoption itself, bringing all the intermediaries into one platform is a very big challenge. Second, I think the point you highlighted about the governance, which I think is a big challenge in all the consortium kind of use cases, and trade finance being one, where a lot of banks and other intermediaries are going to collaborate together. So, of course, so from your perspective, if let's say a bank or a fintech wants to build a trade finance system today, then as you rightly said, that it needs to be taken piece by piece rather than creating an end-to-end system from day one. So what are your suggestions? Where should they realistically start?
Yeah, so I think that more in general, I would say keep it simple. So one of the things I would say more sort of generically is start with a very specific problem that has a clear owner, a willing counterparty, and a measurable outcome. You need a champion for these projects to succeed, and that champion has to want to make money, not to make press releases. And so I think most accessible entry points right now in this space are receivables finance, payables finance. When you're all the way at the very ends of the spectrum with like letters of credit and things like that, you've introduced greater complexity into the process. But payables and receivables are high volume. They're relatively standardized. The assets can be defined with a fairly limited, set of data points, and they don't require every participant in the chain to change at once. So that would be kind of the second piece of advice I would give. And the third is build on infrastructure that already has institutional adoption. This is actually my third layer one, and the first two were both private permission chains because I've always been on the institutional side. And there's a lot of logic for private permission chains. In fact, we allow private permission chains in Avalanche, but the problem is you get these silos. You need to build where there's already institutional adoption, or you need to have, as in Avalanche, a natively interoperable input to that. So network effects really do matter. Being on the same rails as Franklin Templeton or Galaxy or Axiom, which is another exciting build that we've got for cross-border payment flows, really matters both for counterparty confidence, but also for the ability to plug in those pieces you don't want to build yourself. And so keep it focused, make sure there's a very clear objective, make sure you can tie that to a financial outcome that you can then, after you've done the press release, can go back to your CFO or to your board and to say, this is why I need the budget to roll it out, because I can point to the dollars and cents savings or the basis points of capital efficiency or the reduction of risk that is key to making this thing valuable for the company.
I think that's a very sound advice, especially I believe that, running a startup in the space and have been an entrepreneur for the last 30 years, that it is super, super important to have a sound business model and sound business practice unless, there's no motivation to go through all the challenges, which definitely are going to be there. And when we talk about, and I think receivable finance, in fact, the first use case when I started in blockchain in 2017, the first platform I built was invoice discounting. Because I believe invoice discounting or receivable financing is a very simple product, but yet at the same time, and especially when we talk about discounting with recourse, there, where the client also comes into picture, it makes it very, very difficult in the real practice in the Web2 space today, in the traditional finance. And same goes for non-recourse for other reasons, for risk and credit risk, etc. So For both the use cases, I think blockchain could play a massive role. But yeah, the market was not ready at that time. But now we believe with all the necessary ecosystem in place, Avalanche is providing a very sound layer to build not just public use cases for public chains, but also permissioning wherever required, interoperability, liquidity, and access to other tool sets.
So
So
part of that, and you sort of implied it, is the emergence of cash on chain in form of stablecoins. So that all financial transactions need to be paid, and the ability to, and when you're bridging out to wires or ACH, you've got this one point of failure. You've got this difficulty in applying quite the granular level to really make this thing. So that's been another huge development, and again, that's also where I think our multi-chain architecture is so beneficial, because you're not going to get a stablecoin issuer to issue on your L1, your smaller, more private L1. So you really need to maintain that pool of liquidity. That's a great example of where I think this interface between public and private comes to the fore. You can execute your transactions with the asset side on a permission layer one, if that's what you want, or even a public but much smaller layer one, and then settle in and keep the liquidity pooled and liquid on C-Chain.
No, absolutely. I think we are seeing this across various other tokenized fund use cases, where the actual securing the asset, tokenizing it, having KYC or onboarding of various stakeholders, that is happening on a permission chain or a public permission chain. But the secondary market, where the actual token distribution or secondary market is running on a public chain. So yeah, of course, I think it has got a massive ramifications across the use cases in the tokenization space. Absolutely. So one thing about so as you said, technology is not a challenge today. Ecosystem players and ecosystem components are in place. What about legal and regulatory concerns? Do you think what role they are going to play? At what stage we are, where we can say that we are going to see a lot of trade finance adoption in the coming few years?
Yeah, well, regulatory clarity has been essential to the explosion in this space. When I was at Amazon, I had a blockchain digital currency at Amazon, and I will tell you that the U.S. was a regulatory no-go zone back then. Everything I developed was offshore. We've really moved significantly from regulation by enforcement to regulation by rules. The Genius Act has really brought stablecoin in out of the cold to a large extent by creating a federal framework. Before this, when I was working at Amazon, there's really no difference between a Bitcoin and a stablecoin. And in really practical terms, what that means for a treasurer is they need to digital assets need to be marked to market. And at the time, you could mark them down, but you couldn't mark them up. You had to impair them when they went down, but you could. My stablecoin stay constant, but you've got to go through now a process of marking it to market. That's a massive headache that nobody really wants to deal with. So the clarity that we've gotten on a regulatory standpoint, industry-wide, has been extraordinarily helpful. Or specifically with trade finance, and this is something that predates blockchain, I would say. Well, it's been happening for the last couple of years, is we are getting changes in like MLETR, MLETR, in the UCC rules that are beginning to accord to digital assets the same legal weight and force that is accorded to paper assets. So the legal system was, of course, written around the concept of a paper-based asset. And it can be challenging to, even though a digital asset implements the exact same contract terms as a paper asset, the legal system has not been set up to recognize anything other than paper. That's really starting to change. As I said, MLETR, the UCC update rulings, the creation of a CER, or controllable electronic record, which allows control to establish priority even over other competing claims, has, I think, really set the stage for an explosion in trade, in finance in general, but trade finance in particular, because it is so document heavy and so governed by traditional legal frameworks and contract law. that it's gotten a huge boost recently. And a lot of these changes are really very, very recent, within the last even year or so. And so I think we're really poised for a lot of regulatory clarity, and institutions need that. Companies will not come online unless there's legal certainty. We are really getting that legal certainty.
Got it. Nope, I think and hope stablecoin regulation has been a game changer, and we have seen that, because as you rightly said, liquidity or having interoperable payment rails or settlement systems, I think it's super, super critical for any kind of use case within the financial systems. And we have seen some fantastic progress, not just in US, but across the globe, in Europe and Middle East and Hong Kong. So I think, and with more friendly regulations coming in the next 2-3 years, I think will give the right required impetus to the whole financial ecosystem space. So now, Mike, you have already mentioned a bit about how Avalanche architecture is supporting institutional trade finance. You also mentioned about all the different components, and we being partners with Avalanche L1, it has we know the capabilities of the stack and some of the implementations we have done. So you mentioned about some of the institutional giants who are already operating on the C chain or maybe their own Avalanche L1s. So what kind of traction you are seeing in terms of use cases? What kind of use cases you are seeing, specific use cases?
Yeah, and people are operating across both. See, the things that I'm seeing that I'm excited about are that we're really seeing traction in areas like asset-backed finance, cross-border treasury, stocks and equities. So the shift from pilot to production that's happening right now is quite real. So a year ago, a lot of these things were proofs of concept, and today they're deployments with real volume. So Galaxy Digital, for example, closed a $75 million tokenized CLO on Avalanche earlier this year. So that's a real institutional private credit settling on blockchain rails and proving out this waterfall, tiered structure that I mentioned. Axiom, which I think I alluded to earlier, has executed over $1 billion in cross-border transactions in less than a year on Avalanche. And that allows corporate clients to transact entirely in fiat at either end, but enjoy the instant settlement and low transaction fees or low fees that you get on stablecoin rails, and even access better FX rates in a number of corridors because they're dialed into the infrastructure of local payment processors and payment service providers. So they've actually got access to a natural pool of local fiat liquidity, which is very different from the pools that you see on capital markets, which are largely derivatives and non-deliverable forwards based. So cross-border payments is absolutely, I think, one of those use cases that completely took off. Fence, Tranched, and Intane are three builders that are all delivering significant expense savings, time savings, and capital efficiencies with these warehousing and tranched facilities that I'm seeing. We're also seeing some bigger institutions adopt. So Japan's Progmat, which is backed by Mizuho and MUFG and the number of Japanese mega banks, is migrating $2.8 billion of assets onto a dedicated Avalanche L1. Some of these implementations are on C chain, some are on Avalanche L1s. So that is a fully operational migration. It's not a test, and it's actually going to move about 2/3 of the cumulative securitized token and real estate issuance in Japan onto an Avalanche L1. Denari is a way of tokenizing stocks in a way that preserves investor rights and has some unique characteristics to it. They've got $800 million in transaction volume across 250 tokenized US stocks and ETFs on an Avalanche L1 with BitGo, VanEck, and WisdomTree as validators. And then Nonco is another company in the FX space. They're serving over 350 institutional counterparts on its FX protocol, and that's built natively on Avalanche. So these are US ETFs, liquid funds, global payment processors, transacting at production volumes.
That sounds absolutely great. There are quite a few use cases, and as you rightly said, institutions are now very, very serious. There are no discussions about how blockchain can play a role. It's all about how we can implement and go from pilot to production. And we're already seeing quite a few of our customers getting into production now. And in fact, our thrust has been more on the banking and the institutional space in the last 6-7 months. And it has been very, very warm. Yeah, a very warming journey, I would say.
Right. Because I've been in the space about 8 or 9 years, and we're finally moving from this innovation theater phase into live production, and this time will be different has been the mantra for the last 8 or 9 years, but this time really is different. This time we really are seeing them move into production, so it is a great time to be in the industry and to put in the hard yards through the pilots and the innovation theater portion of the industry. So I'm very excited about what's coming next.
So, Mike, from your perspective, how do you see the whole trade finance, specifically trade finance? I think on the tokenization side, lots and lots are being done, as you rightly said, the plethora of use cases. And I think today we are seeing more of the use cases where we have digital twins, but we are going to have native assets as well very soon. But from trade finance perspective, where do you see the industry in the next 2 to 3 years?
Well, I think the paper-based model is going to break down faster than most people expect. I think a lot of these things are slowly than quickly. And that's because the efficiency gap between the legacy trade finance and the tokenized alternatives is now large enough to be competitively significant. We've definitely seen this happen in cross-border money movements, though, one part of this. So it's going to naturally come back to the asset side of this as well. So I think in the next 2 to 3 years, we'll see standardization around the infrastructure layer, around the legal frameworks. Like you say, how do you get a digital twin to be legally enforceable? That's spent a lot of time on. Stablecoins will become the default settlement mechanism for institutional transactions. And I think the first truly cross-border multi-party trade finance networks will begin to reach meaningful scale. Regulatory clarity we talked about earlier, fighting in the US and key markets like Japan, Singapore, and the EU is going to accelerate this. I already mentioned some of the changes to M-Letter, which are in place. And the frameworks are arriving, and I think that's going to allow the deployments to follow. And so we'll be able to not just talk to the engineers about how safe this is, but we'll be able to explain it in terms that fit within a legal framework that the risk committees and the legal teams will understand as well.
No, absolutely. I think it's the business side that needs to be convinced about any use case, any large scale adoption within the organization.
They've got to go convince their risk department. So you got to get a practical level at the innovation group. Then you've got to convince the lines of business, and then you got to go through the risk committees. And those are all sort of distinct steps. That are all
risk and operations, of course. Yeah, no, absolutely. Yeah. So, Mike, I think this was a fantastic conversation. We covered quite a few ground, especially touching upon all the different tokenization use cases where we are seeing a lot of traction, where production deployments are happening in the last couple of years. How Avalanche provides both C chain as well as Avalanche L1 to build permission chain to public permission to a complete public chain kind of deployments. And specifically to trade finance, I think we covered quite a few ground in terms of what are the challenges in the legacy system and how blockchain can play a massive role, taking care of privacy, risk, governance. Technology is solving them all. And I think with a flavor of legal and regulatory friendliness, I think we should be able to get there in the next few years. So thanks a lot for joining us. And it was a great conversation with you.
Well, thank you very much. We obviously always enjoy working with you outside of the podcast. And so it was very nice to come on, and thank you for the opportunity to talk. It was a great conversation.
Thank you. Thanks, Mike. And this is for listeners. If you enjoyed the discussion, please subscribe us on YouTube, Spotify, or Apple Podcasts. We have many more conversations with leaders like Mike who are driving enterprise adoption among institutions, enterprises, fintechs. Until next time, this is Dr. Ravi signing off. Thank you.